Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the exact same checklist, so you can see step by step whether it deserves a place in a long-term dividend portfolio. Today we're examining Sysco Corporation, ticker SYY, the largest food service distributor in North America, serving restaurants, hospitals, schools, and hotels with essential daily supplies. We'll answer, how does this company make money? Is it good for long-term holding? We'll go through the Max Dividends checklist step by step, test financial condition with our 5-pillar secret formula, see what portfolio role it plays with MaxRatio, and determine if the stock looks undervalued today. How this company makes money. First question, do I clearly understand how Sysco earns money? And does that business model make sense for dividend investors? Sysco runs massive distribution network. They buy huge volumes of food and related products, store them in national warehouses, deliver on dense routes to restaurants and institutional customers. Cash flow comes from everyday demand, logistics efficiency, purchasing leverage, not from product hype, advertising budgets, or rapid innovation cycles. Instead of inventing next big thing, Sysco's compounding engine is operational. Expand and optimize network, deepen customer relationships, improve mix and service levels, use scale to defend margins in competitive industry. Model not flashy, but understandable, exactly what matters when goal is dependable dividends. Here are core earnings drivers. Food service distribution at scale. Most earnings from core distribution. Value proposition simple, reliable partner keeping kitchens running with consistent availability, on-time delivery, competitive pricing. In low-margin industry, scale is weapon. Large volume improves purchasing economics, route density lowers delivery costs per case. Broad warehouse footprint serves customers efficiently nationwide. Small execution improvements create meaningful profitability gains over time. Broad customer mix. Sysco tied to food away from home, cyclical at edges, but diversified across independent restaurants, chains, healthcare, education, lodging, other institutions. This smooths results when one sector weakens, keeps cash flowing for dividends even in uneven conditions. Private brands and services. Competitive distribution means Sysco builds stickiness through private label products, customer programs, value-added services. These improve margins, strengthen relationships, make switching harder. For dividend investors, harder to replace equals more predictable cash generation. Operational discipline. Sysco compounds industrially. Continuous improvement in warehouse productivity, transportation efficiency, procurement leverage, pricing execution. Reinvest in distribution footprint to maintain service levels. In inch margin business, process plus scale equals durable financial outcomes supporting rising earnings and dividend growth. Key point: Sysco operates real economy essential. Restaurants adjust menus and staffing, but still need supply. Not recession-proof, but easier to model than discretionary high-yield traps. Logistics and procurement machine wins through consistency when paired with conservative financial management. Business model clear, resilient, dividend-friendly. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter. Companies with 15+ years consecutive dividend growth. Sysco passes with textbook stair-step pattern dividend investors love. Over 15 years, annual dividend climbs from roughly $1 early 2000s to over $2 recently. No cuts, no freezes, steady annual increases. Even through cost inflation, uneven demand, competitive pressures, management protected and raised payout methodically. This reflects real income compounder, no drama, no yield gimmicks, just disciplined capital return mindset. Sysco operates operationally intense industry, but dividend history shows commitment as core policy. Step 1 passed, Sysco behaves like proven dividend eagle with durable raises fitting essential distribution business. Step 2. 5-pillar secret formula. First pillar, sales growth. 10-year revenue trend decisively upward despite food service cyclicality. Mid-2010s low $50 billion range. Recent years low $80 billion. not perfectly smooth, but clear direction. Growth from network share gains, wallet share expansion, structural outsourced procurement demand. Scale, route density, supplier relationships create compounding platform. Pandemic dip was real stress test. Rebound to higher base proves durability. Customers return when activity normalizes. Sales growth past, expanding revenue foundation supports long-term dividend sustainability. Second pillar, profit growth. Profits reinforce revenue story with operational leverage. Decade view shows roughly 9 billion rising to 15 billion recent peak. Post-disruption step up confirms higher operating base. Compounding through volume density spreading fixed costs, procurement discipline protecting gross profit during inflation. Productivity gains across network. No single-year fluke, steady execution builds profit pool, protecting dividends, funding reinvestment. Profit growth past, expanding earnings capacity creates dividend growth runway. Third pillar, net income, classic resilience pattern, long-term upward with visible stress test. Mid-decade 1 billion range, pandemic sharp dip, steady rebuild to 1.9 billion recent years. Post-recovery floor meaningfully higher than pre-shock baseline. For dividend compounding, direction plus recovery ability matters more than perfect smoothness. Sysco absorbed once-in-generation demand shock, maintained dividend commitment, restored higher earning power. Rising net income improves coverage, supports raises. Net income past, structurally stronger earnings profile backs dividend growth. Fourth pillar, dividend payout safety. Decade shows two distinct environments. Disciplined band, reasonable for mature cash-generative distributor most years, then outlier pandemic spikes above 400% and high 100% range when earnings collapsed but dividend held steady. Classic coverage test. Ratio blew out because denominator broke temporarily, not reckless payout policy. Post-shock normalization confirms earnings recovery, restored sustainable coverage. Dividend payout safety past. Key, post-shock normalization back to sustainable levels shows restored profitability funds, payout comfortably. Management treated dividend as non-negotiable during crisis, business delivered coverage afterward. No structural unsafety. Dividend payout safety past, temporary distortions resolved, current coverage supports growth. Fifth pillar, debt burden. Distribution asset heavy, working capital intensive. Leverage expected but must stay controlled. Debt ratio high 0.8s to low 0.9s band. Stabilizes recent years rather than ratcheting higher. No emergency borrowing, no masking weakness through balance sheet stretch. Structural leverage supports scale distribution model with no deterioration trend. Strong profitability contains pressure currently. Debt burden past, managed leverage, no structural risk while operating performance solid. Company financial condition, financial score 97, exceptionally safe. Clearing 90+ threshold signals, balance sheet durability for multi-cycle holding. Sysco proves resilience through real-world stress, operates higher revenue/profit base than mid-2000s, maintains dividend discipline. Step 2 past overall. Financially elite dividend business built to endure food service cycles. Does it fit our plan? MaxRatio classifies portfolio role, combining yield, growth, financial strength. Sysco lands growth eagle territory. Moderate yield but strong compounding profile. Roughly 2.45% current yield delivers solid cash flow. 5-year dividend growth, 16%, 57 consecutive raise years, payout averaging high 80s%, reflects pandemic distortion but long-term culture clear. Designed for patient compounding where income builds steadily through raises. Best as core dividend grower, not high-yield anchor, not aggressive growth bet. Fits investors prioritizing rising income stream over maximum day-one cash while avoiding fragile balance sheets. Is the stock undervalued today? Cheaper than competitors? Max Dividends shows fairly valued versus food distribution peers. Average valuation for profit profile, no peer discount, but no obvious overpayment. Cheaper than history, yes versus 10-year norm. Current PE around 24.57 versus historical 38.69 average. Investors pay less per earnings dollar than decade norm, though COVID earnings depression inflated historical multiple. Better yield than usual? No, 2.37% versus 2.65% 10-year average. Share price strength relative to dividend pace. Moderate starting income, case rests on growth, not yield pop. Analyst consensus, limited near-term upside. Average 12-month target, $90.69, implies minimal gain from current levels. Buy consensus, but muted expectations fit fundamentals-driven hold. Final decision. Sysco delivers quality. 57-year dividend streak. Revenue $50 billion to $80 billion. Profits $9 billion to $15 billion peak. Net income $1 billion to $1.9 billion recovery. Payout normalized post-pandemic. Debt managed 0.80 to 0.90 range. Financial score 97 confirms elite resilience. Currently fair versus peers, cheaper than own history despite COVID, multiple distortion, yield slightly below average. Proven dividend eagle fits as long-duration grower, prioritizing steady income, progression over day one, yield maximization. High-quality compounding engine for cycle-aware dividend portfolios, collecting dependable cash while business steadily raises payouts. Subscribe for more analysis. This is not investment advice.